Here, I remember last time we were doing an accounting cycle practice. It's about a corporation that started in 2014. And I remember that the corporation issued stock for $350,000 and we debit cash for $350 and common stock has been credited. And then we posted, of course. We purchased equipment. So debit equipment increased, cash decreased, credit. So cash goes out of pocket, far away. But equipment is an asset, goes in our pocket, close to us. Remember that story? So that's also saved in the general ledger T accounts. Utility expense, we paid $12,000. So we record that as utility expense for the whole year. Prepaid rent paid at the beginning of the year, sometime in January before we move in for here, 2 years in advance. So that will be an asset, prepaid rent, and we paid. It's not a rent expense yet because we didn't get any benefit out of this asset, out of this payment yet. Later on in the adjustment, we need to record the proper amount of rent expense. Unearned revenue, because someone gave us, a client gave us $65,000, I believe, and we recorded as a liability. Why? Because we didn't perform the job yet. We didn't complete the job yet. So it's a liability as of this moment. But by the end of the year, again, we need to see how much of this job has been completed. Based on the percentage of completion, we will recognize proper amount of revenue. And dividend payable, it's a liability we recognize later on because the board of directors, they declare dividend, but it's not paid yet. So we record it as dividend payable. Instead of cash credit, we record it as dividend payable. And we update our T accounts by posting all those transactions. For the end of the year, we record this the adjusting entries for end of the year, 3 type of adjustment. Those adjustments, normally you kind of don't know exactly what to adjust because there are so many. So normally what we do in a kind of, regular or big size corporation, we have to create a worksheet in order to not make a mistake in regards to what needs to be adjusted. So we bring all balances from the trial balance from the T account into the trial balance, make sure both sides are equal. And then we suggested some adjustments. Let's say we suggested that rent has to be reduced, prepaid rent, and rent expense needs to be recognized. The equipment got a little bit older, a year older. So for that 1 year old of 1 year worth of using that equipment, you record a depreciation expense, which is in here, and you credit accumulated depreciation. Also, we talked to management, and the management said $2,000 of that liability unearned revenue has been left at the end. So the rest, which is $63,000, has been earned. There you go. Liability will be reduced and revenue will be recognized. Both sides are equal. We put these 2 adjustments and trial balance in one place. We call it adjusted trial balance. It's equal again on both sides. Then we got an idea about income statement in here. And the balance sheet, as you see, it's balanced at the bottom. So far so good. We got the worksheet and we got the adjustments idea. These adjustments are just an idea for you to help you to do the adjustment. So referring to this, we go back to adjustment and we did our adjustments one by one. So all these numbers are coming from the worksheet. Now, the adjustments are done. They are posted to the general ledger and we prepared financial statements. So income statement is done, showing $28,500 of income, which is same as worksheet. Then statements of retained earnings should be prepared, which is beginning retained earning as a brand new business is 0 plus net income minus dividend. That gives you end retained earning as of December 31st of 2014 for $6,500. So why this is number 2? Because you need income statement first in order to get the net income, and then apply the net income into number 2, which is statements of retained earning. Now, why retained earning is number 3? Because you need to prepare it in order to be able to finish your balance sheet. So the $6,500 retained earning goes into the balance sheet, and here we go. That's the balance sheet. That's my assets, $380,000. That's my liabilities, $24,000, and that's the $6,500 that I am talking about comes from retained earnings statement, right there. So this is copied from here, and add them up. Liability plus equity equals to total asset. Life is good. So far so good. But before we go to 2015 and start operating and making money in 2015, we need to kind of reset or so-called close. When I say close, doesn't mean close and throw it away. It means just reset it. Some temporary accounts. Because every year you want to know exactly how much money you make. You don't want to mix it up with previous year because then you don't know what's going on. So every year, every period is separate than the previous period. So for 2014, we need to close temporary accounts. Temporary accounts are accounts that belongs just to that specific year. Let's say 2014. Like what? Like, let's say revenue. Where is revenue? Here. So revenue is a temporary account. I would like to close that. Rent expense is a temporary account. Then we close all expenses. How many expenses do I have? Depreciation expense. You see, that's another thing needs to be closed. Okay. So those first revenue and then expenses. Any more expense? Yes, utility expense. Right there. And we close that. Okay. So after expenses are closed, the last thing you close will be dividend. There you go, and that's the last thing you close. So you close revenue, then expenses, and the last thing in dividend. The only problem is where do you close this? Because if you want to debit revenue to close this revenue, you know, revenue is credit, right? In order to reset it, you have to do debit to make it 0. But the problem is if you debit this, then you credit what, right? So we came up with an idea. We call it opening a new temporary accounts for 5 minutes, and we call that account income summary. And the account number for income summary is starting with 7. Let's say 710. So we close this into income summary. Income summary is just a temporary account that needs to be go away very soon. So it's just a temporary account that goes away soon. Okay? So if I debit this revenue to reset it, then I can easily credit income summary, right? So let's do that. And this is how it works. So you go to closing entries, you highlight those closing entries, that's what you close. Okay, so closing entries as of December 31st, we need to close revenue first, and revenue is a credit balance, normal. So in order to close it, you do the opposite of whatever it is. So that will be a debit. So here we go, revenue, and equals to whatever it might be. Let's go see how much it is. Here, $63,000, enter. And 63 will pop up there. You see, I'm not typing anything, I'm just copying it. So the credit side should be for sure, swear to God, equals to 63, 100%, right? And we said, what's the solution? Credit what? We came up with a genius solution. We said we create an account for 5 minutes. We call it income summary. So let's do that. So credit income summary. And you click what? Click save. Right? So click save, that means post it to the general ledger. So let's go post it. Let's go to revenue. You see that? On the debit side, equals to, go up, get it from the debit side, enter. So therefore, revenue right now has a normal balance of 0. Okay, so equals to that box, normal balance, 63, minus the debit side, enter 0, voila. So revenue is closed, or so-called reset. Okay, we reset revenue for this year. So next year we start fresh again, and we hopefully make more money. Any questions so far? If you have questions, please unmute your microphone, ask, and I will try to respond. Okay, since revenue is closed, the next thing we close is all expenses. We have rent expense, we have depreciation expense, and we have utility expense to close. So let's go ahead and close that. So in order to close all those expenses, you see they have normal balance of debit, right? We need to do opposite, which is credit. Okay, so I don't know how much the debit side will be here, so I'm going to leave one line open. Okay, leave one line open. So let me highlight this. This is my closing. You see, that's my closing. And this is my second closing. So here we go. I start from the second line and I say utility expense, let's say, or rent expense, and what else we have? Rent expense, utility, depreciation expense. So doesn't matter which one you close anyway. So utility expense. Okay, so that will be a credit equals to, you see, it is a debit, right? So sorry, that box equals to 12,000, enter. And there you go, 12,000 will pop up. Next one is rent expense. And we go credit again, equals to, go down, And that's 18,000. Enter. Next one is depreciation expense equals to, go down, and this one right there. Enter. Now, so how much is my debit then? The debit is sum of that box all the way up to here. Enter. So this is sum of C52 through C54. And you debit what? Debit income summary. Now, remember, in accounting classes, not in QuickBooks, but in accounting classes, so you want to have indent for all credits. Okay? That way, you show that the first line is a debit, definitely, you see debit on the towards the left side, and all credits are indented towards the right. Okay, now you need to say save. So let's close, let's post this to the T account. So let's post it. And let's start with debit of income summary. So let's go to income summary. Oops, did we post the other one? No, I forgot the income summary here. So let's post that one first. I forgot that. Okay, so let's go to income summary because it's blank. Here, equals to that box. Okay, now you go to the debit side, you say equals to, and you go up, and equals to that debit of income summary 34.5, enter. Cool. So now how much is my income summary at this moment? Income summary at this moment is, let's draw one line only. Okay, so income summary at this moment is equals to the big side, 63 is larger number, minus the smaller number, and the answer is below the larger number. So it looks like it's on 28,500 on the credit side. That's my summary of income. And if you really look at it, 28.5, it's exactly my summary of income in here. You see in my income statement, shows the same thing. Cool. So remember I said this is just for 5 minutes. So here we go. It's okay. We summarize it. Thank you so much. 28.5. Got it. Now what? Now we have to get rid of this. Okay. So you have to, now that it's summarized, income is summarized, you have to close it. So question, how do you close this? It's on the credit side. You do the opposite, which is debit side. How much? 28.5. So to income summary, you need to do debit to close it. Okay, let's do that. So income summary, you debit that here equals to that box, enter. Cool. And because that's a debit, equals to the same number, enter. Cool. But the problem is, what is credit? Remember, in any business, all your actions, profits, dividends, ends up in the retained earning. Everything ends in the retained earning. Look at this income statement, statements of retained earning. You see everything ends in the retained earning. Net income is here, dividend is here, everything is in retained earning, reflected in the retained earning. Okay, so that's what we're gonna do. So we're gonna use retained earning. Okay, that's cool. So that's how I close my retained earning, income summary, I mean, into retained earning. Cool. So let's click save. And post it. So income summary debit, let's do that. Go to income summary with debit income summary equals to, go up, that box, enter. Okay. And now we draw a line again. This one is a double line, equals to 28 on the credit side minus debit side, enter. There you go. So now income summary is closed. But the other one is retained earning credit. So let's go. Do you see anything here that says retained earning? No. Okay, then create one. Retained earnings. We create the T account. Account number is, let's say, 330. Starts with 3. And there you go. So it will be credit or debit. Let's look at it. You see it's on the credit side. Huh? So let's go to the credit side. So go to the credit side, equals to, go up, that, credit, enter. There you go. So retained earning has been credited for 28.5. Cool. And if you look at the retained earnings statement, exactly that's what we did. We said it was 0 before, agree? And now you add net income, which is 28.5. And that's exactly what I did. It was 0 before, and now we add 28.5. Okay. The last thing we need to close is dividend. Do you see that? That's the last thing you close. Okay. So help me. How do I close dividend? It's on the debit side. Normal balance. Dividend, normal balance, debit. How do you close it? Credit side. Okay. Let's do credit. Here we go. Go at the bottom. Dividend credit equals to, let's see how much. Here, 22,000. Enter. Cool. So swear to God, the other side, the debit, will be equals to 22, 100%. And what's the name? Remember, everything ends up in the retained earning, right? So here we go. Retained earnings. Cool. Control C, Control V. So what do you do now? Click Save. Imagine it's a QuickBooks. In QuickBooks, you don't, okay, let me talk about that one. In QuickBooks, you don't literally do that. In QuickBooks, that's the way QuickBooks work. In QuickBooks, you don't close this. QuickBooks will close it for you anytime you ask for a report. Not close it, but QuickBooks is kind of closing just for a few seconds to prepare you the report. But it doesn't literally close it manually or physically. So if you have a QuickBooks, you always continue. You don't need to close. But anytime you ask QuickBooks, give me a report for, let's say, income of 2015, QuickBooks knows that whatever is in 2014 has to be separated. So technically ignoring the 2014 and just give you a report for 2015. There is a process that you can close in QuickBooks if you really want to close. One of the reasons you might want to literally close it because you don't want one of your bookkeepers go ahead and touch something in 2014 by mistake or by purpose. So like in my bookkeeping, I don't close it. Why? Because it's just me. There is no one else. But if you are a big company and few people are goofing around in your QuickBooks, you don't know who's going to do what. So in that situation, you might say, you know, it's better just to close. And in case by mistake you want to enter something in 2014 while you are in the middle of 2015, then QuickBooks will say, okay, 2014, it's closed already. If you want to change it, first of all, it's not a good idea. Second, if you really want to do something, you need a password. So that will prevent to do something goofy in 2014 while you are in the middle of 2015 or 16. Okay. But why I'm teaching you all this closing concept? Because it's very important to understand the fundamental of accounting. Because if you don't understand this, you don't understand what's going on in a business and why your reports comes up the way it's supposed to come up. Okay, so let's post this. So retained earning, debit, dividend, credit. So let's go. Retained earning debit equals to, go up, enter. And what's the balance right now? Let's see. Equals to, the big side happens to be on the right side, large number minus the smaller number, the answer goes below the large number. And here we go. The retained earning is $6,500 as of December 31st, 2014. And that's exactly what you said in here. Word to word. So your report now is reflected in here. Isn't that beautiful? So in QuickBooks, if you go and say, what is my retained earning as of December 31st, 2014, it will say here, $6,500. balance. Okay. Now, the next one is, sorry, dividend. So let's go dividend, credit equals to, go up, get it from there, enter. And now your dividend, normal balance debit, equals to 22 on the debit side minus 22 on the credit side, enter. Okay. Any question so far? No? Okay. So what we did, as you see, now we have a retained earning balance with $6,500 inside. Income summary is closed. Revenue is closed. Accumulated depreciation has $4,500 balance. Depreciation expense, why is not closed this one? I forgot to post it. Oh my goodness, did I? Oh yeah. You see all those expenses, I need to post them. So I talked about summary and then I forgot. Okay, let's do that anyway. So let's close all those expenses just to make sure. So here we go, expenses was supposed to be credited, so equals to, and that's that box, enter. So let's make it 0 now. And double line equals to the debit side minus credit side, and utility expense is 0. Okay, the other expense was rent expense. We forgot to post it, so here we go, equals to rent expense here, enter, and then go to the debit side, say double line equals to the debit of 18 minus credit of 18, enter, and the balance is 0. And the depreciation expense next equals to, on the credit side, go up, get it from the top, 4,500, enter. Go to the debit side of normal balance of depreciation expense, put a double line over there, and equals to depreciation expense, debit side, minus credit side, enter. And those balances needs to be $1, so let's make it $1. Okay. So my throat is dry. Okay, sorry about that. So retained earning has a balance of 6,500. Income summary closed, revenue closed, accumulated depreciation, that's fine, has a balance of 45. Depreciation expense is closed, revenue expense is closed. Dividend payable, it's a liability, so you can close that. Dividend is closed, good. Unearned revenue, it's a liability, $2,000, you can't close that either. Those are permanent accounts. If you are liable to someone or if you have an asset, those are permanent accounts. If you have equity, let's say common stock, those are all permanent account. Retained earning, permanent account. So prepaid rent has an asset of $18,000. Utility expense is closed. Equipment has a balance of 48. Cash, I have $319,000. And common stock, 350. So let's put all these good numbers with balances accounts into final report that we prepare, and we call it as of December 31st, 2014. And the first one is, and remember, trial balance has a debit side and credit side. Don't forget that. Trial balance is the only account, only report that has a debit side and a credit side. That's the only report. Everything else doesn't have a debit side, credit side, like income statement, like retained earning or balance sheet. The only report that has a debit side and credit side is trial balance. Okay, so let's go cash. That's the account we have. Because it's the first number, gets a dollar sign, okay? Equals to cash, 390. I have prepaid rent. It's based on liquidity. So after cash, prepaid rent is liquid, is current asset. So let's go to prepaid rent and equals to 18,000, enter. And remember, only the first number needs a dollar sign, so I'm gonna take the dollar sign away from that. Okay. Then the next one is asset again, but fixed asset goes at the bottom, equipment. And that will be equals to my equipment right there. Okay. After equipment, the next one is account number 168, I believe. After equipment, equipment is 167. So 168 is accumulated depreciation dash equipment. So accumulated depreciation dash equipment, it's a credit side opposite of equipment. It's a contra account to equipment. So that is on here. Enter. Again, this is the first number in the column, so it needs a dollar sign. Cool. Keep going. No more assets, right? So assets is gone, now is liability. We have dividend payable, we have unearned revenue. Okay, so dividend payable looks like it's account number 210 and unearned revenue is 213. So therefore, dividend payable should be first. Dividend payable. And that's a credit side, equals normal balance liability credit side. And that's 22,000, enter. The other one is unearned revenue. It's again on the credit side, equals to 2,000, enter. And we don't want dollar for those. Okay. And after liability, we have what? After liability, we have equity, common stock, right there. So, common stock. and that's a credit side equals to equals to that box. Enter. After common stock, we have retained earnings. So equity is at least two parts, which is common stock and retained earning. So here we go. We have those two parts in here, equals to, and that's $6,500 there. Enter. No dollar sign either. And after retained earning, what is left? Let's see. Anything else left? That's about it, right? Okay, so let's add them up. Let's go, let's say, to this line and use a double line thing. And here we go to this box. I say sum, enter. Then I go to this box, do the same thing, or go to this box, grab the fill handle and pull it to the right. There you go. Okay. So how do you like it? Is good post-closing trial balance okay now? Yes? Okay. Now, we did everything from A to Z together on this. A to Z. The top, all the way to regular journal entries, transactions for the year, end of the year adjusting entries, closing entries, preparing financial statements. Okay. Okay. And all the general ledger T accounts are updated properly. And we did the worksheet together. And we did all of this in Excel. Let me tell you something. You might remember this forever. And you will see what, if I am correct or wrong. Some of you, maybe you are in accounting major. That means you're going to take many more accounting classes. Some of you, this is your only accounting class probably you want to take. No matter which case is true for you, this is the only time that you got an opportunity to see all of this from A to Z, starting from the top of accounting cycle, all the way to the end, including worksheet, including teaching you how to do work on the worksheet in this class. And this class only. I don't think you take any other accounting 1A class and you will have any of this stuff. You will not.